Welcome to all of you to today's SUERF Baffi-Bocconi e-lecture on key takeaways from the ECB's new financial stability report. Ryszard Kokoszczyński from the National Bank of Poland will moderate the meeting. John Fell and Tamarah Shakir from the ECB are going to speak, and Anna Alyina from the IMF will comment. With this, I hand over to Ryszard.
Thanks, Ernest. Good morning, good afternoon, good evening to everybody who is with us today. So, John, over to you.
Thank you very much, Richard. Good afternoon, everyone. So, on behalf of Tamarah and myself, let me first thank Ernest and the SUERF board for inviting us back and giving us the opportunity to present the highlights of this 33rd issue of the ECB's Financial Stability Review. So this issue has obviously been prepared against the background of a waning and a waxing of the COVID-19 pandemic, and the macro financial implications of the pandemic continue to dominate our assessment, with the financial stability outlook remaining challenging. Now, while we have had announcements in the past couple of weeks of successful trials of 3 vaccines, and that brings cause for optimism, we also know that logistical lags in dispensing them imply that it is unlikely that COVID-19 will be brought under control before the second half of next year. And it will be some time after that before economic and financial activity has fully adjusted to this unprecedented shock. Now, against this background, in the next 15 minutes or so, I'd like to focus my remarks on the 3 main messages of the review and their implications. And then I will pass the floor to Tamarah, who will probe a bit deeper into a few selected policy issues that are covered in the review. So turning to slide 2 and the 3 main messages of the review. Well, first, at some stage during the summer, the letter K rose to prominence as the best letter descriptor for a pattern of uneven recovery across countries, economic sectors, and even income cohorts. Now, while COVID-19 did represent a common shock, its impacts have been differentiated depending on economic structures, as well as health and economic policy responses in different countries. It has also left some countries and sectors more vulnerable to shocks than others going forward. Now, the second theme is that timely, vigorous, and coordinated policy responses were successful in mitigating liquidity challenges before they got out of hand. Now, although those challenges are now in the rear-view mirror, solvency issues are becoming more prominent, and they will need to be tackled with different policy tools. And then the third message is, thanks to the vigorous policy response and different to earlier financial crises, the banking sector did not so far amplify the COVID-19 shock. Lending continued. But with bank profitability significantly eroded now, and with credit losses expected to rise, there is a risk that the response of the sector could yet become pro-cyclical. So let me now go to slide 3, and starting in a little more detail on the first theme, the K-shaped recovery. Stock markets were quick to price in the differentiated impacts of social distancing, and subsequent economic activity data has largely borne this out, raising concerns about economic divergence. Now, the left chart here shows how the technology sector has outperformed financials, and that's both in the US and in the euro area. Not only has there been sectoral differentiation, but there has been significant differentiation across countries as well. With the Euro Stoxx 50, as you can see, they're underperforming relative to the US, and then many euro area countries in turn have underperformed the euro area average. Now, there is a concern also that the rebound from the lows of March has been overly exuberant. That is, there is a sense of that in the US, but also in the euro area, and that's relative to, for instance, changes in expected earnings in a number of sectors. The right chart then shows time series of the dispersion of value-added growth across euro area countries and also across sectors. And as you can see, cross-sectoral dispersion, so that's the yellow line, has been larger than cross-country dispersion. And it has been greater than it was during the economic contraction that followed the global financial crisis, as you can see there. Cross-country dispersion too almost reached double the levels that it reached during the global financial crisis. Now, turning to slide 4 and property markets, we see a K again here. So housing markets have proven remarkably resilient to the COVID-19 shock, and this has probably had a lot to do with the fiscal support to the household sector, in particular. Social transfers and temporary relief on tax burdens have shielded the sector from the income shock to a much greater degree than was the case that we saw during the global financial crisis. At the same time, mortgage holders have benefited from lower interest rates, and working from home may well have shifted the housing demand curve to the right as well. And as a result, house prices have continued to rise across the euro area at a brisk pace, to the point where our valuation models suggest that they could even be vulnerable to correction if, for instance, fiscal support were to abruptly end. The commercial property market, by contrast, so it's been in the lower part of the K, has been witness to a drying up of liquidity as transactions have dropped. You can see that there on the middle chart compared to the previous 2 years. And there has been either marked deceleration of price inflation or even outright declines, depending on the sector or the subsector within the commercial property segment. So this has been particularly marked for retail and office commercial properties. You can see that there on the right, which may also have to contend with the lasting consequences of households working and also shopping from home. Now, going to slide 5 and corporate sector vulnerabilities, the K-shape also applies here by firm size. The cash flows of smaller firms have been hit harder by the COVID-19 shock than was the case for larger firms. And one indication of this is seen here on the left. The green dots are showing the percentage of total corporate loans that is currently guaranteed by governments in 4 selected euro area countries. And then you can see that the data is split by firm size, large firms and small and medium sized enterprises. And you can also see that smaller firms in several euro area countries have been much more reliant on government guarantees than larger firms have. Now, also on the right hand side, under the qualification that correlation does not necessarily imply causality, we do see cross-country divergence in corporate sector performances depending on the degree of sovereign indebtedness in the country where the firms are located. So on the right, in countries with above median sovereign debt to GDP ratios, declines in corporate profitability have been much more severe than was the case in countries that have lower sovereign indebtedness. And this has prompted concerns about a possible sovereign corporate nexus, where, for instance, and I just pick out one channel, lower corporate tax revenue weaken sovereigns, and the sovereigns themselves may be forced to support weakened firms going forward. Now, turning to slide 6 and the second theme, the emergence of solvency risks. No matter which part of the corporate credit spectrum one looks at, slide 6, are we managing to? So no matter which part of the corporate credit risk spectrum that one looks at, after the initial blowout, corporate bond spreads have now settled back more or less to pre-pandemic levels. You can see that there on the left. So we have where the spreads were just before COVID-19, at the peak of the COVID-19 shock, and then where they are now in red. And you can see that the red bars are very close to where the blue bars were back in January. But we see this as evidence for disconnect between financial asset prices and the fundamentals. While it is true that corporate insolvencies have been lower this year compared to last, and this is depicted, by the way, on the yellow line on the right-hand chart, the number of insolvencies, or the Z scores for insolvencies, that after an initial surge, ratings downgrades have also slowed down in recent months. Now that arguably reflects desired impacts of policy actions, but looking forward, Several indicators of corporate credit risk are on the rise. The number of firms currently on negative watch by rating agencies, and so at risk of downgrade, is now higher than it was at the peak seen during the global financial crisis. Default rates in the leveraged loan markets are climbing, and the number of covenant amendment requests from borrowers in those leveraged loan markets has been rising as well. Also, a newly developed composite corporate vulnerability indicator, it's explained in box 1 of the FSR, has also been rising sharply, and we have that on the chart on the right. It's there in blue, and you can see that it's risen markedly, and up to comparable levels of what we saw in the global financial crisis. So let me go to slide 7 now, and the corporate credit outlook, which hinges critically on, in our view, on getting the timing right on the phasing out of fiscal support measures relative to the vaccine dispensement reaching a critical mass. So on the one hand, phasing out too early may imply cliff edge risks, possibly undermining the solvency of otherwise viable firms that have, by the way, survived until now. And on the other hand, phasing out too late may pose risks for banks and sovereigns who are bearing the risks of those measures, and it could also lead to a misallocation of capital to the extent that measures are propping up zombie firms. Now, as you can see on the right, demand for government guaranteed loans continued well after the initial shock, and this was even more so for loan moratoria. Now, if it is correct that vaccine dispensement will not reach a critical mass until the second half of next year, the left chart, and it's showing the timing and the phasing out of the measures, that it would suggest that premature phase out is currently the more likely scenario, although this could, of course, change depending on the policy choices that policy authorities take regarding those measures. Now, going to slide 8, the significant rise of sovereign indebtedness resulting from the fiscal response to COVID-19, while clearly necessary to avoid economic collapse, it has been giving rise to concerns about a possible resurgence of the sovereign bank nexus. And at the same time, we also see corporate indebtedness rising. So on the chart on the left, which shows 2 scatter plots in time of sovereign and non-financial corporate debt ratios, since the end of last year, virtually all countries have moved in the northeast direction towards the upper right quadrant where vulnerabilities are the greatest. And there are now, as you can see, several countries that are in this quadrant. Those are the most recent observations are in blue. Now, at the same time, as shown on the right, there are a number of banking systems which have both relatively high holdings of domestic government bonds and also high corporate sector NPL ratios. They're exposed to a large fraction of NPLs. Now, although we have yet to see how the NPL impacts of this year's economic contraction plays out, several countries appear to be vulnerable to the risk of enduring adverse dynamics of what we call a sovereign corporate bank nexus. Now, moving on to slide 9 and the third theme, banks' vulnerabilities. Profitability has come under pressure, as I mentioned at the beginning, this year from several sources. First, as interest rates declined, lending volumes were insufficient to offset the narrowing of margins, so that net interest income made a negative contribution to banks' second quarter ROE this year. Second, and at the same time, net fee and commission income also made a negative contribution. And then third, and by far the most important source of profitability deterioration, it's marked on the red bar there, the waterfall chart on the right. In the middle, there was a surge of loan loss provisions. Now, looking ahead, with margins under pressure and non-performing loans expected to rise, analysts are now expecting a full year return on equity for the sector this year of less than 2%. That's shown on the left, and then as seen on the right, about 3% only next year. Now, turning to slide 10, when Euro area banks started reporting their COVID-19 financial performances, or their post-COVID-19 financial performances, there was some discussion among analysts and others about whether they were provisioning adequately for the future wave of NPLs that we can expect. Now, we have analysed this issue in some depth in the FSR with a bank level panel model of provisions. That model covers around 60 banks over 20 years over a range of euro area countries. And on the left, you can see the gap between actual and predicted provisions for the first half of this year. So that's the red bars there around the zero line. And so those red bars, they might indeed support the under-provisioning view, because they're saying that the gap between what would have been expected by the model and what was actually reported was positive. We advocate taking some caution in interpreting the findings from this model, because of course the model doesn't take account of the effect of government guarantees, which will have explained some of that provisioning behaviour. But nevertheless, we also see significant variation of provisioning patterns across both countries. Now that might be expected given the K-shape that I explained earlier. The economic impacts have been differentiated across countries, but we also see differentiation within the same countries, which is a bit harder to explain. So asset quality concerns could be explaining why, in price-book ratio terms, euro area banks have been languishing at the bottom of the class among mature economy banking systems, and you can see that there on the right. And this is a concern because it implies that the cost for banks to raise equity in the market lies significantly above the return on equity. Let me now go to my last slide 11, and sum up on those three main messages. We continue to see, as I said, a challenging financial stability outlook lying ahead, and the list of vulnerabilities is long, as you will have seen if you had a chance to read the FSR. With the K-shaped pattern of recovery, these vulnerabilities are clearly affecting some countries and some sectors more than they are others. Now, since the last financial stability review, the COVID-19 shock has, in our assessment, evolved from a source of liquidity stress to a source of solvency risk. So whereas economic and macroprudential policies were initially geared towards containing the immediate economic fallout, we have now moved into a phase where ensuring near-term recovery has become paramount. And as I said, there may be solvency challenges lying ahead. And this may well require more targeted policy responses and balancing those risks from cliff edges, so including the phasing out of government loan guarantees and also the statutory moratoria, and balancing that against the risks of a misallocation of capital if those measures were to persist for too long. And to address banking sector vulnerabilities, it also requires responding to uncertainties, including considering options for the management of non-performing loans. Looking a bit further ahead and preparing for a post-pandemic environment, there will be a need to manage medium-term financial stability risks, including the sovereign corporate bank nexus that we have identified in the FSR. We don't see that as a near and present danger, but a little bit further down the road. It will also require a strengthening of the institutional and the policy setup, including completing the banking union, making progress with the capital markets union, creating space for macroprudential policy to respond to future financial crises, and also developing the macroprudential framework for non-banks, which was an issue that I didn't get into too much detail in this presentation. But let me now pass the floor to Tamarah.
Yes, so in the last few slides, I'm just going to focus on three of the policy issues that were in John's map there on slide 10. Bank capital buffers, non-bank policy, and climate. So first, if I start here, the release of banks' capital buffers. So notably, banks' macroprudential capital buffers. That's been one of the first real tests of the capital framework that was introduced after the last crisis. And specifically, when these policies were introduced in March, what we wanted was for banks to allow their depletion in capital, using those capital buffers, that is, instead of reducing lending to the real economy or deleveraging in order to protect their positions. As John mentioned earlier, the losses haven't materialised yet. We're expecting to see that really over the course of 2021. But we are currently monitoring very closely how effective the buffer policy is. So will banks let capital ratios fall? The initial evidence on that is a bit mixed, and you can see some of that in this slide. So the left panel here gives a sense of it. We split banks into quartiles according to how close they are to the combined buffer requirements. So the blue bars here are the banks which started closest to where buffers would have been binding had they not been released. And between Q1 and Q2 this year, the far left panel shows it was those banks that saw the largest fall in average risk weights versus other banks. And that's one indicator of an attempt to boost capital ratios through adjusting risk. But then we've got better news on the panel that's beside it, which is those same banks did not show any signs of reducing lending to households and firms more than other banks. So like I say, mixed evidence on how banks might be responding to the capital buffer release. In terms of policy, though, one issue is emerging is that we need to ensure that banks are not discouraged in using capital because they fear authorities will try and increase the requirements again too soon. ECB supervision has already said banks won't need to replenish any reduced buffers until the peak of capital depletion is reached, which may well be later next year. Our view set out in the FSR is that there is a very strong argument to remain very cautious on capital replenishment paths. And on the right, you see here the results of an exercise where we model the impact on euro area lending of different approaches to restoring capital. So that could be starting either at the end of 2021 or the end of 2022 and taking 1 year or 2 years to get back to pre-pandemic capital. And you can see when we compare this to a baseline case, without that increase, we would really have quite a large impact on the recovery and lending if we acted too soon. And we start to get much more mild impacts if we wait until the recovery is more solid, and banks may have better chances of organic capital generation. So like I say, overall, we advocate currently a very cautious approach to thinking about capital rebuild and being able to communicate that clearly to the banks. Moving on to non-banks, the FSR covers in detail that after the March turmoil, when funds in particular saw large outflows, we've seen the return of inflows over summer, and alongside that, a return to risk-taking by investment banks. In particular, we've seen the return of signs of liquidity risk across a range of funds, which you can see in the right-hand side here. It suggests that if there is another round of market turmoil and funds face similar outflows, either from investors or from margin calls, we could also see the same risks re-emerge in their ability to meet redemptions, and or for them to engage in fire sales of assets to also try and meet these needs, making things worse. At the same time, we still see significant gaps in the macroprudential framework for non-banks. And as set out in the FSR, we advocate a review of tools such as suspensions of redemptions, redemption gates or swing pricing, and a check that they can be applied to manage systemic risks rather than individual risks. Furthermore, we still see a case for examining the role of fund leverage in exacerbating pro-cyclical dynamics. And the experience in March suggested a case for some particular attention to be focused on money market funds, given that we are learning more and more that investors seem to have high expectations of these funds having cash-like properties. That all sits well with the programme that's already been announced by the FSB, and we're very engaged on that. Finally, a word on climate risk, although the topic deserves more than a word, of course. We continue to expand the coverage of this topic in each issue of the FSR. So this time we expanded our discussion of transition risks for banks, i.e. their exposure to high carbon industries that they need to adjust. We've also started now talking about exposures to physical risks as well. So that is exposures to assets that might suffer from a climate event such as floods or fires and so on. But we are also recognizing that as well as asking the financial system to manage the risk of existing assets, we could increase the resilience overall if we get the financial system to help finance the transition to a more carbon neutral economy. Here we discuss in the FSR the growth of green markets. That's a combination of both funds focused on environmental investments or green bonds as well. And both of those have been growing significantly, although they remain small relative to the conventional market. We also document in a box in the FSR that these assets have proved much more resilient to the initial COVID turmoil than conventional funds or bonds. However, on the policy side, and that's what you see here, the concern is that to really make this market sound and to help develop it further, we need to work fast to improve disclosures and information on what these investments are doing. So this map here tries to draw out how valuable enhancing climate-related disclosures of companies and assets could be, both through market channels, so exerting more market discipline, and through regulatory channels. And as ever, we also add on that development of a real capital markets union could further support the growth of these particular markets in an integrated way. With that, I just leave you with our overall summary of the FSR here, bringing together both parts of the presentation. Thank you very much.
Thank you, Tamarah. So now let's start with Anna's comments.
Thank you very much for the opportunity to be a discussant on the ECB's new financial stability review. I should say at the start that the views expressed in my remarks are my own, do not necessarily represent the views of the IMF. The November FSR contains a wealth of interesting analysis and important insights for policymakers. And I should say that the key messages are very much aligned with the messages from the recent IMF's Global Financial Stability Report, which I had the pleasure to work on. So in my comments, I will focus on the key vulnerabilities, the role of policy support, and some of the policy trade-offs going forward. So the story of the pandemic is well known by now. So unprecedented crisis required unprecedented policy response to keep the financial system functioning, maintain the flow of credit, and avoid a wave of bankruptcies. So these crisis policies were intended to create a bridge to economic recovery pending a medical solution to the pandemic. However, as was already mentioned, that there are still concerns about new waves of infections and lockdowns, and despite the recent vaccine boost to risk sentiment, the outlook is still a bit foggy. So my remarks will focus on three things: key vulnerabilities, the role of policy support, and policy trade-offs. So stepping back a little bit and looking at the evolution of the global financial conditions, and that's chart on the left, you can see that the pandemic shock led to a significant sharp tightening of financial conditions. But this tightening was also reversed fairly quickly, much faster than during the GFC, thanks to the swift and massive policy support. In advanced economies, the steady easing of financial conditions in recent months, you can clearly see on the right-hand side chart, has been largely driven by continued recovery in risk asset markets. In emerging markets, except China, this easing has been driven by declining external borrowing costs that you can see in the green here. So the important point to keep in mind here is that the continuation of these supportive financial conditions actually is the key assumption. It underpins the projected rebound in global growth next year. So according to the IMF's latest World Economic Outlook, global growth is expected to rebound by 5.2% next year, and that's green dashed line. This also means, if you look at this chart, is that the entire growth distribution for next year is mostly in positive territory. But that said, risks are still clearly tilted to the downside, and that was the point that was also made in the previous presentation. So according to the GFSR, there is a 5% probability of a sub-zero growth, global growth next year, which is fairly high by historical standards. So we are clearly not out of the woods yet. At the same time, the pandemic has also exacerbated financial vulnerabilities, which may pose additional headwinds to the recovery. In fact, many countries have entered the crisis with already elevated pre-existing vulnerabilities, most notably in the asset management, non-financial corporate, and sovereign sectors. So this radar chart from the latest GFSR shows shares of systemically important countries with elevated vulnerabilities in the key sectors like sovereigns, non-financial firms, household, banks, insurers, and so on. And the lines here refer to different points in time. So GFC is a red line, April 2020 black line, and the shaded gray area refers to the latest assessment. So you can see the vulnerabilities have increased in a number of sectors since the last GFSR. In fact, looking at the sovereign sector, after the COVID outbreak, financial deficits worsened significantly. As a result, also public debt to GDP ratios are estimated to be at the top of their historical ranges in most of the large economies globally. And this is shown in the right chart, which shows the range over the last 3 years, and dots indicate the estimated 2020 public debt to GDP ratios. So what this means looking ahead is that the fiscal capacity to backstop the private sector may become increasingly more limited. And that underscores the fact that the main challenge will be to recalibrate policy support so as to ensure a sustainable recovery in the near term, while at the same time avoiding a further deepening of financial vulnerability that could put growth and financial stability at risk over the medium. So, as was noted in the FSR presentation, non-financial firms came under significant liquidity strains following the COVID outbreak. So to cope with cash shortages, many firms had to increase their net borrowing. While this has helped avoid a wave of bankruptcies at the early stages of the crisis, so this additional borrowing has led to a further increase in already high corporate debt burdens. And these could translate into increased solvency risks going forward, especially if the recovery is delayed. So there was quite a bit of a discussion in the previous presentation about policy trade-offs. So I thought we would try to lay this out here a bit more explicitly. So looking ahead, the exit strategy from these policies will have to be carefully calibrated to avoid what I would call type 1 and type 2 errors. So type 1 error is withdrawing support too soon, which would lead to a spike in bankruptcies and ultimately delay the recovery. And type 2 error is overextending support, including to possibly non-viable firms, which could exacerbate debt overhang resource misallocation over the medium term. So let's have a closer look at some of these specific policy measures and associated trade-offs. So the decisive central bank interventions restored market functioning and also effectively put a floor under the risk asset prices, helping cushion the impact of the liquidity shock. So the chart on the left here is very interesting. It shows that corporate bond yields rose sharply during the COVID, since the COVID outbreak, but then declined steadily in the following months. So falling yields here stand in sharp contrast with deteriorating corporate fundamentals. So as you can see, there's a stark divergence between rising default rates, dashed line in the chart on the left, and falling yields on the US high-yield bonds. So the IMF staff analysis that we've done for this last GFSR suggests that much of the decline in corporate bond yields since March has actually been driven by policy support. So the chart on the right, as you can see, shows cumulative changes since the start of the year in the US investment grade yield, decomposed into the contributions of corporate fundamentals, blue, nominal risk-free rates, shown in green, and other policy, what we call other policy support. And that includes a lot of proxies for different policy measures, such as asset purchases and other facilities, and that's in red. So what you can show here is, what you can see here is that policy measures have broadly offset the deterioration in fundamentals that otherwise would have pushed the bond yields higher. So this apparent real financial disconnect does raise concerns about markets becoming too dependent on policy support. But also, it makes it clear that until the recovery takes hold and fundamentals improve, the withdrawal of policy support can indeed trigger a sharp market correction. So in addition to the central bank policy measures, there was also a broad range of fiscal and financial policy support measures that were deployed to support firms' balance sheets. So the chart on the left here shows the intensity of different policy measures adopted in Europe. So as you can see in advanced economies, shown here in blue, there was a tendency to rely more on measures with direct or indirect fiscal costs, such as wage subsidies, grants, and loan guarantees. In emerging Europe, there was a tendency to lean more heavily on debt moratoria to cushion the impact of the shock. The right-hand chart is very interesting. It focuses on firms that were solvent before the pandemic, but got into trouble after the shock hit. It presents the post-COVID distribution of firms by solvency and liquidity. So this is based on the simulations that were done for the October 2020 regional economic outlook for Europe. This is work that's based on simulations using a very large sample of firms, around 4 million firms from Orbis. So the bottom line of this analysis that even after accounting for all policy measures, there's about 1/10 of previously solvent firms in advanced Europe and 1/4 of firms in emerging Europe that still face liquidity shortfalls. And moreover, 7 to 8% of firms could become insolvent, even though they have been solvent before COVID. More importantly, without these policies, and this is also very interesting results here, some of which are set to expire, as was mentioned in the presentation this morning, these numbers would have been 2 to 3 times higher. So the bottom line here is that there may be still a significant number of firms that depend on continued policy support. And for some firms, more support, including possibly equity support, may be needed to ensure solvency. So moving on to the next slide, the chart shows that despite this strong policy support, corporate default rates globally have been climbing higher in recent months. And most notably in the energy sector and in other contact-intensive sectors that have been most affected by the pandemic. But as was noted in the FSR presentation, this increase has been more muted than one might expect, given the size of the economic shock. Because the future path of defaults remains highly uncertain. So the chart on the right shows the trailing US high-yield default rate, and that's the green line. And then, at the end, you see the forward-looking part, which is the range of default forecast by rating agencies for next year. And you can see that the range is unusually wide. So what this means is that there's still a lot of uncertainties. And one important source of uncertainty, which is extremely difficult to ascertain, is the extent to which the shift now preferences for digital work and lifestyle will influence the post-pandemic structure of the economy. But one thing is clear, that looking ahead, the future path of defaults will likely be shaped not only by the evolution of the pandemic, pace of recovery, structural shifts, but most also importantly, by the phasing out of the policy support, which is, again, a policy choice. So now let me turn to the banking sector. So most banks entered the COVID crisis with much stronger capital and liquidity buffers than before the GFC. So in addition, banks, of course, also benefited from accommodative macro policies, as well as specific borrower support and bank-oriented regulatory measures that allowed them to continue lending through the pandemic. So again, looking ahead, the policies will need to be carefully calibrated to avoid this, type 1 and type 2 error, where type 1 is a premature withdrawal of accommodation, which could lead to a spike in banks' credit losses, tightening in lending standards, and a credit crunch, which is the risk that was again mentioned during the FSR presentation. And type 2 is the opposite. It's overextending press bank profitability over the medium term. So in order to better understand the impact of the pandemic on bank balance sheets, we ran some simulations also on the evolution of bank capital ratios under both the baseline and the adverse scenarios from the October World Economic Outlook. So the assessment presented here relies on the IMF's bank stressing methodology and publicly available data for about 350 banks in 29 jurisdictions, accounting for around 73% of global bank assets. So as shown in the chart on the left, in the baseline WEO scenario, global GDP rebounds to pre-COVID level in 2022, while in the adverse WEO scenario, again, the recovery takes longer, although the difference is not very significant between these two scenarios, you can see. Another important contribution of this exercise that it also attempts to quantify the impact of policies that effectively mitigate the potential impact of the pandemic on bank capital buffers ex ante. right? So these are the kinds of things that would actually reduce the need for provisioning. Again, it's another point that was discussed, an important caveat that was mentioned by Tamarah. So these policies that we're trying to quantify include borrower support policies such as loan guarantees and other measures that reduce borrowers' PDs and LGDs, as well as bank-specific policies aimed at creating capital space, like such as releasing some specific capital buffers. So there are some more details in the chart on the right, but I just wanted to give you a general idea of what this are. So what are the key takeaways from this analysis? In the baseline scenario, capital ratios fall, but recover quickly. In the adverse scenario, of course, there's a more sustained damage. Two things. First, as you can see in the left-hand at the left-hand side chart, there is a weak tail of banks, shown in red, approximately 8% of assets that would fail to meet the minimum regulatory requirements. The important point here is that in the absence of policy support, which is assumed in the simulations in the layer with policy mitigation, this weak tail would have been much larger. It would have been 14% of assets rather than 8%. The chart on the right shows a bank capital shortfall for the entire sample as well as for subsamples of banks. And again, here we present quantification both with and without policy mitigation measures. The aggregate capital shortfall without policy mitigation relative to broad regulatory requirements is about 420 billion, which is significant, but maybe not as significant as one would expect given the size of the shock. But what is more important here is that the estimated impact of mitigation policy reduces the shortfall by about half. So it reduces it to 220. That again underscores the fact that taking into account all the relevant policy support measures makes a huge difference. And also, until the recovery takes hold, this means that some borrowers may continue to need support. And also, as emphasized in the FSR, clarity on the usability of bank buffers, which is one of the important components of these policy support measures, is critical to avoid a credit crunch. And another thing, again, that we can infer from this is that stress testing could indeed be a useful tool in calibrating the desirable pace of rebuilding bank buffers. As this is something that was discussed in the presentation as well. So now let me turn quickly to the NBFIs, non-bank financial institutions. So fragilities in the NBFIs, notably in asset management sector, have clearly aggravated market dislocation during the March sell-off. So while central bank interventions have, of course, limited the fallout, they have not addressed the underlying problems. So again, as noted in the FSR, liquidity mismatches in asset managers tend to persist. And credit risk exposures have increased, which is something that we found as well. So what are the type 1 and type 2 policy errors in this case? So one is, again, a premature withdrawal of policy support, which may result in a sharp market correction, which could trigger a replay of the same dynamics that we have seen in March. And the type 2 error is the situation when a prolonged period of a combination of low yields, compressed market vol, and entrenched perceptions that central banks will continue to backstop key markets actually encourage excessive risk-taking and a further built-up vulnerabilities, including increasing financial leverage, which again, there's some evidence that this is already happening. So in the next slide, there are just a couple of charts that illustrate that the central bank interventions have indeed been critical in avoiding a significant distress in the asset management sector after the pandemic shock. So as you can see on the left-hand side chart, asset managers experienced intense outflows during the March sell-off, but fund flows have recovered fairly quickly, even including flows to prime money market funds, following a rebound in asset markets on the back of strong policy interventions. The right-hand side presents the results of an interesting empirical analysis on the behavior of fixed income funds during the March sell-off. So again, in the FSR, it was mentioned that fire sales and distress in the asset management sector remains a risk. Indeed, what we see here is some evidence that fixed income funds that were forced to sell assets in response to redemption pressures had some adverse impact on both asset prices and market liquidity. So specifically, the chart on the right shows that assets that were under this type of selling pressure, forced selling by investment funds, have seen larger declines in cumulative returns, that's shown in green line, and also a bigger widening of bid-ask spreads, and that's shown in the very last panel. So the bottom line is that means that if the NBFI vulnerabilities remain unaddressed, then a more prolonged period of market stress than perhaps what we've seen in March, and greater redemption pressures could lead to broader distress among asset managers and more sizable fire sales than what we've seen this year. Just to conclude, a couple of thoughts at the end. So one point that comes across very clearly in the FSR is that in many countries, vulnerabilities have increased across multiple sectors: sovereign, corporate, banks, non-banks. In addition, the links between sectors may have tightened as well through different channels, through standard macro-financial channels, through increased holdings of sovereign bonds by financial institutions, high sovereign liabilities, maybe greater use of bank credit loans, and so on and so forth. So what this means is that a policy misstep in one of the areas may cause a shock that would quickly propagate through the entire system. The policy roadmap that was presented in the FSI is also really useful for thinking about policy priorities at different stages of the crisis and recovery. So the policy roadmap in the last GFSR, which I'm showing here, I would say, which contains very, very similar steps and priorities to the FSR, distinguishes between different stages. In particular, the first stage is gradual reopening under uncertainty, and the next stage is pandemic under control. So what we see is that most countries are still somewhere in the first stage. And the implication of that is that the main priority for policymakers is still ensuring a sustainable recovery, which, of course, being mindful of all the other potential risks, vulnerabilities, side effects, and intertemporal trade-offs, suggests that at this point in time, we should worry more about type 1 than about type 2 errors. Thank you very much.
Thank you, Anna. John, Tamarah, would you like to have a few minutes to react to Anna's discussion comments?
Thanks a lot, Richard. I mean, that presentation of Anna was really excellent. It was actually very complementary to what we presented, and I think there isn't anything in it that I would have any issue with whatsoever. I mean, I think it's very much aligned. Anna makes a very important point in what she said at the very end about the importance of the coordination of policy action. That mistakes in one area. I mean, given these interconnections now that we have, the sovereign corporate bank nexus that we've been identifying, it does give rise to, and it's a kind of a triangle of vulnerabilities, and you know, weaknesses in any one of those corners of that triangle can spill over to the others, and likewise with you know, policy errors and those type 1 and type 2 errors that Anna was talking about. Our assessments are actually incredibly close, which gives us some comfort as well, because of course in this business of diagnosing risks for financial stability, you're looking out into the tails, and yeah, there's a lot of uncertainty around these kinds of assessments, as we know as well.
We have 3 questions from the public. The first one coming from Kinka Geke about the idea of substituting the possible stigma effect for those banks that won't get a green light to pay out from supervisors with the general dividend payout ban. as the better option?
Well, I mean, as you know, Kinga, thanks a lot for the question. I mean, as you know, I mean, this was a measure that was introduced as an extraordinary measure, but also a temporary one. And I mean, of course, it's being discussed now in policy circles, what to do next, how to construct a pathway back to normality. The objective of the measure was to retain capital in the banking system to allow the banks to continue lending and to avoid the credit crunch. On the other hand, of course, I mean, we know that there have been implications for the pricing of bank stocks, for example, coming from the dividend ban. It may have temporarily raised the cost of equity of banks. And the reason I'm saying that is that there are trade-offs. Addressing short-term issues, but maybe also creating issues down the road as well. So what I mean by that is that, for example, dividend bans can have the adverse implication of eroding the investor base for banks, which has already been eroded over the last number of years in the euro area because price-book ratios have dropped to incredibly low levels. And the income generation of banks is not what it was in the past. On the stigma, yes, I mean, on the one hand, having a blanket ban, I mean, of course, avoids the stigma for the weakest banks in the system. But what it also does is it prevents the strongest banks in the system from paying out dividends. Bank stocks are income stocks. They're not like, you know, Berkshire Hathaway, which never pays a dividend. I mean, one of the reasons for why investors invest in banking stocks is because they pay dividends, and especially for banks that may have a greater capacity to pay dividends, that may be having an adverse impact on their cost of equity as well. And so, you know, by supporting the weaker ones, in a sense, it has a spillover to the stronger ones as well. So, I mean, the reason I'm mentioning that is because there are trade-offs. But I mean, you're quite right in the way that you pose the question. I mean, it would avoid the stigma.
Okay, so we have another question from Jean-Pierre Chaudet about the possibility of this risks realizing in some future. And in the perspective of the highly overvalued share prices on the global scale, this would be a very substantial risk going forward, according to Jean-Pierre Chaudet, a risk which was neglected in the presentation. Would you like to comment on that?
Well, it wasn't, I wouldn't say it was completely neglected, but I mentioned it en passant in the presentation. I mean, we had been flagging in the Financial Stability Review actually for quite some time about what we were calling a hunt for yield, which had compressed risk premia to very low levels. And by the way, I would include, you know, hunt for yield to the extent that bank stocks and dividend-paying stocks are part of the, you know, the attraction of an investor base looking for yield. That stock prices may have been driven already too high before COVID-19 struck. Equity markets, I mean, as you know, have not directly benefited from the policy responses. The asset purchases on both sides of the Atlantic were not directed towards equity markets, but we know that there is portfolio rebalancing and probably there were some indirect effects. And we continue to emphasize that we think that there is misalignment, between equity prices and the underlying fundamentals. But I think actually the analysis that Anna has done is very useful in that regard, of showing, you know, that part of asset prices that you cannot explain at all, and that part which is due to the policy response. I haven't seen that kind of analysis done for stock markets, but I suppose that there would be, you know, there's definitely some impact on stock valuations coming from the low interest rates, of course, and the fact that long-term interest rates have come down a lot. So we're not saying that all of the rally that we have seen since March is not fundamentally driven. And we know the technology sector, for example, has benefited a lot from the longer-term consequences of COVID-19 and all of, you know, everything that we're benefiting from the technology, even now, being able to do this teleconference, to be able to do this meeting virtually. But yeah, I mean, we continue to indicate in the financial stability review that there are pockets of misalignment across a range of asset markets, including equity markets.
Yeah, so I just wanted to add this to this one point that in the GFSR we actually do present some estimates of asset price misalignment for a wide range of assets. So in this presentation, I focused on investment grade bonds, but we also have estimates of misalignments for a range of equity markets. I mean, it is true that both falling risk-free rates and equity premium compression have supported equity market performance this year. But when one tries to assess the extent to which the compression in equity risk premium has been driven by this massive policy support, it becomes really challenging. I mean, we're still working on getting sort of robust estimates of that. It's been relatively easier to do for corporate bonds, but for equity markets it's challenging. So yes, we do see misalignments clearly, but we also recognize that some of these misalignments can be explained by this massive policy support, but quantifying the exact contribution of policy support.
Thanks, Anna. So coming back to the Ernest question, is both presentations emphasize the importance of timing and finding the right balance between, as Anna called them, type 1 and type 2 errors. But the key challenge is, according to Ernest, the coordination and combination of policy areas, what Anna showed on policy roadmap. Ernest asks how to get such optimal coordination done. Do you think that they may happen institutionally? How to coordinate this globally, taking into account spillovers and externalities?
So, I mean, there are many global coordination mechanisms, including the G20 group that meets regularly to discuss policy challenges. And I mean, the IMF is also such a forum. I think in Europe, clearly there are many similar for. I think there's a recognition that this is a common shock, and the actions of policymakers in any given country have unusually large, both positive and negative spillovers on others. And that's why perhaps in this case, the coordination issue may be less challenging than some other circumstances. But I mean, it remains to be seen how effective the sort of the current mechanisms will be. But you know, some of the encouraging signs of progress on policy coordination include, for example, the G20 sovereign debt restructuring framework that has been agreed on recently. I think that's a major breakthrough and a big, strong positive example of successful policy coordination. And all the work that is now ongoing at the FSB on the NBFI macro-pru policies and so on, I think would be another example. Thanks,
Anna. John, would you like to add something?
Yeah, I mean, I think actually Anna has said a lot of it. Actually, I think I saw something. I mean, on the FSB work, I think Tobias Adrian is doing a seminar very soon on this. I just saw it pass through my LinkedIn. But I mean, I think Anna's quite right in what she listed as examples of the policy coordination. And of course, many of us are involved in those discussions globally. I mean, you can see, I mean, that we're rather aligned on our assessment, and yeah, I mean, some of us are located in institutions that have a particular policy, set of policy instruments, and I mean, of course, within the ECB, I mean, there's been a lot of coordination, and then I mean, in Europe more generally, we have the European Recovery Fund. I mean, there's been a lot that maybe people might have even would not have thought possible before COVID-19. So I mean, I think there's a lot to be optimistic about in terms of coordination. I mean, I think maybe one aspect that I don't know how easily it is done, the coordination between the people who are dispensing the vaccines and the economic policy makers. I think a dialogue is needed there. I mean, to get the timing right on that one, to be not withdrawing measures too early. Yeah. So I mean, I'm not privy to that, but I have no doubt that there are information channels there.
Okay.
I see you had a question yourself, Richard,
Yes.
on sovereign bank nexus. I mean, I don't think that okay, so you're asking if the greater holdings of sovereign bonds by banks may reopen the debate on regulatory treatment of sovereign exposures. That's your question.
Yeah.
You know, I mean, I think maybe, Richard, what we need to see is first, you know, to what extent is this transitory, temporary, and to what extent is it permanent? I mean, you know, I mean, the flip side of governments issuing new paper. I mean, we have lots of data in the FSR about how much issuance has been going on, and the figures are enormous, and somebody has to buy that paper. And to some extent, having the banks there as stabilizers to be able to absorb the increased supply is short-term positive for financial stability. Again, it's another one of these trade-offs. But then going, you know, into a more medium-term horizon, the question starts to become about the vulnerability of, you know, the fortunes of the sovereigns and the banks are even more interconnected than they were before. So I think the answer to that question really depends on you know, for how long the banks remain overly exposed, let's say, although I'm using that term reluctantly, because I think that there was some necessity to have the banks on the buying side in all of this as well. So
I see.
I think it's a bit soon. I mean, we haven't yet. I mean, the sovereign debt markets are not telling us right now that there are concerns about sovereign credit risk. So, yeah, I mean, it's just something that we're flagging for something that is there a little bit further down the road, and the policymakers need to be thinking about this, you know, when conditions start to normalize.
Okay, so the answer is too soon, and that I understand. There is a comment by Fritz Nauschnik saying that if low interest rates are part of this misalignment story for equity risk, that the solution might be for Eurosystem to buy stocks. Comment on that?
I mean, I'm not on the monetary policy side of the ECB, but it's a rare thing that central banks have been prepared to expose themselves to the risks in equity markets. I think it's been done on very rare occasions in very few countries around the world, and so I would not hold out hope for that. Let's put it that way.
Okay, thank you. Anna, there is a question from Ernest to you about corporate insolvency backings.
This is a very interesting exercise that was presented in the October 2020 Regional Economic Outlook for Europe. It's chapter 3. So if you want to get more technical details, you can have a look at that chapter. But the idea is to look at a very large sample of firms for both advanced and emerging European economies. I think I mentioned over 4 million firms with data from Orbis in the original sample. And then, you know, isolate those firms that have been solvent pre-COVID, and then look at the distribution by solvency and liquidity post-COVID to see how many of the firms have run into difficulties, either in terms of, you know, liquidity shortfall or, you know, solvency shortfall exposed. And so these are the, you know, the results that I discussed. And so the numbers are actually not insignificant. And so the bottom line is that basically there's still a non-trivial number of firms that are reliant on continuous policy support. And, you know, one has to be mindful of that. And also just again to the point about the potential for liquidity risks to morph into solvency risks that was mentioned in the FSR presentation. So there are some firms that may require solvency support, just liquidity support, to stay afloat. And again, we are only talking about firms that were solvent pre-COVID. So it's not just, you know, some sort of zombies that have been around for a while and then perhaps may not be worth saving. So these are firms that used to be solid before the shock and experienced problems after the shock.
I think Tamarah has been working on this topic.
We probably did it the other way around, actually, Anna, which was we were looking at what where were we in terms of firms that you might call zombies, depending on your definition, before COVID? And our sort of preliminary analysis suggests that the number of those firms had fallen a lot compared to, say, 2014, but was perhaps still higher than you might have thought in the early 2000s. And I think we're using the same data set, so we're also using August data. So it's a slightly lagging data set. So it's decent quality in 2018, poorer quality in 2019, and so on, in our opinion. Actually, in our case, one of the questions we were asking was how many of those firms might be eligible for public support, given the criteria that is used in the loan guarantee schemes. Those loan guarantee schemes are intentionally really sort of catch-all. And so at the moment, our answer is a lot of zombie firms could, in theory, be eligible for a lot of public support measures. And that's probably okay for the kind of emergency we're in at the moment. But as you start to think about next year, extension of the programs and so on, I do think it might be useful for people to consider the criteria a bit more stringently. That's really a personal view, so that's not in the FSR, I should say, and based on that work. But I need to go back and scrutinise those slides and that material. But I would say we have similar concerns that there is a cohort of firms that either were already in the cusp of non-viability before COVID and have been pushed into it, or where they look temporarily non-viable, but depending on how COVID plays out, actually, they may be able to come back. And it's a really hard call to make right now. We really don't know, do we, whether if the vaccine comes into play, all of the distancing measures get lifted, or whether some form of distancing remains much longer than that.
Okay, thank you, Tamarah. We're exactly at the time we scheduled for the end of this webinar. What's left for me is only to say how grateful I am to John, Tamarah, and Anna. I learned a lot. It was very interesting. And I'm tempted not only to browse through the review and the IMF's GFSR, but to read them in detail. So thank you very much indeed.
This concludes our webinar. Thank you very much to John, Tamarah, to Anna and Ryszard, and to all of you for participating. I think this was really a very instructive, very rich hour and a quarter. With this, I would like to conclude this webinar. Thanks again to all of you. We would be happy to meet you at our next meeting. Thank you and bye-bye.
Thank you. Bye-bye.
Thank you. Bye-bye.
Bye. Thank you.
Bye-bye.